shift focus back to earnings. And let's talk about CARE Ratings. The stock, of course, has been in focus. The last 3-month price action, almost about a 51% uptick. And in the last 12 months, it surged in excess of 81%. So let's talk about CARE's numbers. Given that their earnings snapshot, the operating revenues were higher by 31.6%. You had the EBITDA margin as well expand all the way to 15.95%. Let me welcome on board Ajay Mahajan then to talk about what their numbers look like and what's, of course, the future visibility going forward. Ajay, hi, good morning. Good to have you on the show. As I see it, it's been a good quarter for you. Help us understand what have been the growth drivers.
Sure. Firstly, thank you very much, Aisha. Very nice to speak to you after a very long time. I have a reasonably good sort of report to give. Let's take a breather and just step back and say, what has CARE been going through, right? I mean, CARE is going through a very deep transformation in the course of the last, I would say, 12 to 24 months ago. And I joined the firm in April of 2020. We have ensured that we continue to remain focused on transformation. What do I mean by that? What I mean by that is we are a rating agency, and therefore at a very core level, we needed to work on our quality of the processes and improve our analytical rigor. While not compromising on quality, we are trying to regain our market share, which we had lost quite substantially in the last 3 or 4 years preceding this period. So our focus is honestly that while Q1 growth is good, both at a console level and also at a standalone level, we have posted 9 to 10 crore of revenue improvement, but we have also got some expenses increased because we are investing in technology, and obviously we are also improving the human expenses, the human resources expenses in the company to be able to attract the right talent. We have also filled some senior leadership positions in the course of the last 1 year. So the aggregate picture that emerges is that we have improved our PAT for the first quarter by about 10%. And more importantly, our subsidiaries, which were, till now not really contributing meaningfully, have improved their operating performance by 75% in this quarter. So that's an important number to take away. Well, the absolute value of that revenue still, Aisha, is in the region of 8 to 9 crores. But this number was 4.5 crores last year in the corresponding quarter. So I think the message is threefold. Continue to focus on quality. Number two, while focusing on quality, try and grab back market share that we lost over the last 3 years. And, systematically, through marketing and analytical rigor, claw back our market share. And the third is to invigorate our subsidiaries to also start diversifying the revenue set at CARE.
About diversification, Ajay, but how is it that you're looking to leverage technology and expand your digital reach and initiatives?
Yeah, that's a very good question, Aisha. I would say twofold impact of technology in our business. The first is that, just the complexity of rating 8,000-9,000 companies, some of them fall off as non-cooperating issuers, but still there is a bulk of 5,000 to 6,000 companies we rate. Now, while rating these companies, how to stay on top of all the information about these companies to ensure that we take timely action, that we are 100% or better in compliance with what the regulators like RBI and SEBI expect of us. I think there is a tremendous use of technology in our rating processes, which is something that we are adopting. It's a by and by thing. It's not digital as in, we click our fingers today and we get the results tomorrow, but technology is a journey. So that's one application of technology. And the second application of technology, to my mind, is both in terms of improving predictive analytics at rating companies. I think that has to improve. We cannot stay with age-old traditional system of only historically analyzing balance sheets and profitability accounts. We need to move with time, and technology through artificial intelligence and machine learning can actually improve that capability for a rating agency substantially. That's the second point. I may add a third point. The third point is that, in the non-regulated businesses, like we have a technology services business for BFSI, in that business, there is tremendous use of technology in terms of providing capabilities to third parties like banks, private banks, public sector banks, global banks, smaller geographies outside the country, which are still on Basel II where we do a lot of software and services exports, where we help these companies understand credit risk, market risk, operational risk in their businesses. So these are the three immediate applications of technology at Care Ratings that we are thinking of.
Okay. Ajay, how would that help you take on board new businesses as well? Because like you mentioned, right, there are hundreds of companies out there waiting to be rated. So how will this technology leverage help you take on, cope with more business? And how do you see growth shaping up going forward?
Yeah, so, well, the broader point in technology was to actually not just grow business. Of course, it will definitely help grow business, but also improve the quality and analytical rigor of our rating operations. Because what is most critical to us is Care brand. Care brand has to stand for quality. So that's the first quick answer to your question. The second is that there is significant amount of credit penetration in this country that needs to be achieved. Of course, that penetration is largely driven by the lending activity and the overall banking support activity provided by banks and NBFCs in the country. But we largely are a business that grows at the back of improving leverage and credit in the economy. And as you know, in the last 4 or 5 years, there has not been that much of investment demand coming from corporate sector in general in new capacity additions. We are hopeful that we are at a point where some of the capex cycle appears to have bottomed out, and if not tomorrow or day after or 6 months later, but we are certainly hopeful that with the improvement of modified credit ratios that we track, with the improvement overall of the deleveraging of the corporate sector that we have seen in the course of the last several years, we are hopeful that the next round of India growth story will definitely come and start seeing some growth in capital expenditure, and that augurs well for rating agencies. In general, I'm not saying it will happen next quarter, but I'm saying overall, we are seeing some bottoming out there and early green shoots.
Okay. How are you seeing demand for credit from businesses, the landscape of corporate credit over the next few years, Ajay?
Yeah, so high level, I think, like I have mentioned, we are seeing the demand for new business coming in the first quarter. That has been very encouraging. Let me give you a broad sense what I'm saying. Normally the first quarter of most businesses in financial sector, since I come from lending activity and banking before this, I can say that Q1 of virtually across financial services is generally the weakest quarter in the year. Despite that backdrop, I think Care Ratings has posted a reasonably strong increase in its ratings revenue, also driven by new business logins. So that gives us an encouragement that we are actually going to see, hopefully, more activity in the pipeline in regards to demand from corporate sector for ratings improving for the rest of the 3 quarters. And perhaps, like I said to the earlier question, hopefully the larger demand around capex and more term requirement of borrowings from corporate sector should improve, as we are also seeing commodity super cycle at least taking some basic roots globally, and some of that impact will be felt in India, as some of the industries have not added capacity in the course of the last few years. So there are 2 elements to what I'm saying. The first is that we are seeing reasonably good new business pickup in terms of initial ratings growth in this quarter, which is the more here and now picture. And then there is the larger element of capex improving, which is more the medium term, which will also augur well for ratings business.
Ajay, I want to come to you on one last bit, and this is something that you're probably looking at very closely. The financial services space clearly has had that jarring impact of the COVID-19 pandemic, both the first and the second wave. In the first quarter, a lot of companies, a lot of banks have reported issues with very small loans. What is the kind of stress that you're seeing across the board in these books?
So high level, since I'm not personally actually involved in the rigor of the ratings exercise, but I have a reasonably good high level view. My high level view is that, the last several years have actually, in a way, decimated the risk appetite in general of the banking system in terms of their ability to finance large ticket wholesale banking loans. And this time, COVID-1 and COVID-2, if I may say it, has actually impacted the appetite on the retail side as well, particularly on the unsecured side and the lower end of MSME business. And in the unsecured, I'm also counting microfinance risk. Now, some of these risks will bounce back, where when we talk to some of the sort of leading microfinance companies in the country, and even, the MSME bankers, we get to normally hear that, this will pass, and sure enough, it will pass. But I think the immediate challenges of the banking system are that when the banking system was trying to grapple with corporate risk, and I overheard the previous program talk about IBC, some of those frameworks are very nicely geared towards trying to resolve the past problems the bankers have faced. But I think the fresh problems are more coming from unsecured MSME and unsecured retail. The point I'm making is some of this will pass. However, in the short term, this has compounded the risk appetite issue in the banking system. But sure enough, once we are past COVID-2, also with the help of what governmental and Reserve Bank of India, massive liquidity support and all the other help that's also being provided towards keeping the yield curve stable in the government securities market, I think the environment will improve. Now, the simple point is the pace of that improvement may be somewhat moderated in the next few quarters, but hopefully with the global demand for products, services, infrastructure growing, and global demand for commodities improving, I think the next round of growth may not necessarily immediately come from consumption growth, but it may come from infrastructure and capital expenditure-led growth.
Interesting, very interesting points. Thank you so much, Ajay, for taking the time, and I wish you all the best for the rest of the financial year.
Thank you.